this kind of chat online discussion on contemporary topics. Try to do it every month, but sometimes we miss out also because of certain other priorities and engagements. And this time, I must acknowledge that we are having a gap after a gap of almost 2 months. And just to set the tone, set the ground for this, as we all would be knowing that global trade and financial markets are currently navigating a complex landscape shaped by the geopolitical shifts, monetary policy adjustments, and evolving trade agreements. Currency markets are experiencing volatility due to concerns over interest rate movements, inflationary pressures, besides being sensitive to the central bank interventions, which is a major key moving factor, though sometimes people see this as a disruption. Trade negotiations, particularly between major economies, continue to influence supply chain and investment flows. Additionally, financial institutions like banks are having challenging time adapting to the regulatory challenges and technological advancements that are shaping the global e-commerce or global commerce or the trade. In this background, today we have with us Ms. Sakshi Gupta, Principal Economist at HDFC Bank, where she is leading the Treasury Research Team. Apart from building banks' views on Indian macroeconomics and public policy, Ms. Gupta also covers global currencies and rates. And before joining HDFC Bank, she also worked as European economist at HSBC and at CRISIL as India economist. So in sum total, we can say that we have got someone who has got a very good exposure and understanding not only about the Indian market, but also about the global markets and the European market in specific. Incidentally, Sakshi also was a co-author of a book, which in the time when it was released, it was seen, if I may say, as a controversial and a challenging topic at that point. The title of the book was Should Britain Leave the EU? A great debate between political integration versus market liberalization. And I must say that it was very timely release when everybody was discussing, debating, and confused about what's going on. That provided very good insight to the markets. And today we are very happy to have you here today, Sakshi, and welcome to this discussion forum. For your information, I must tell you that we have got participants from banks and financial institutions. These are the people who are working in the corporate offices, central treasury, the trade teams, as well as the branches. And there are certain people, maybe some of the corporates also join for these kind of topics, depending upon their interest and their involvement in thing. And very to happy to have you here today with us. And I also know, as you said, that you have not been keeping well, running a little bit of fever. And thanks once again for sparing time for us today and being joining us today, despite your not being very good health. So we'll try not to bother you much
No, I'm
today.
thank you so much for inviting me today for this talk. And I'm very glad to be part of this discussion. Hoping that this is enriching for, everybody who's joined in today.
Thank you. Thanks a lot. Without much setting the ball, I will just say that we all know, as I said in my opening remarks also, the current global economic environment is characterized by the significant disruptions in international trade, high volatility in the financial markets, and increased uncertainty around monetary policies, as we all are witnessing nowadays. Markets have been volatile, influenced by the inflationary pressures, central bank interventions, and shifting investor sentiments. Trade dynamics are evolving as nations increasingly favor the bilateral arrangements over multilateral frameworks, reflecting geopolitical tensions and protectionist policies. Situation is further accentuated by the Big Papa, the tariff war set in motion by the United States. So my first question to you, Sakshi, would be, do you view these trends as indicative of any fundamental global transformation, or are they merely temporary market fluctuations and a short-term market aberration? What's your take on that?
Right. So I think you set the context very well in terms of what has been happening over the last couple of months. I think, as you rightly said, this is now not just about where trade flow is moving, across the world, where on again, off again tariff announcements have become almost like a daily routine, right? Where I think businesses, corporates, policymakers, central banks, everybody is very confused as to where some of these things are heading, right? So I think that piece is leading to a lot of short-term volatility in the market, right? Which is very visible in how currencies have been moving over the last, 2 or 3 months, right? So to give you an example, I have a chart here of the US dollar index, right? And the red line is showing you how the US dollar index has been moving over, the last 1 year. After Trump came in, you did see the US dollar initially increase very, very sharply, right? And this was led by markets thinking that, look, Trump has come in, US growth is very, very strong. There was some amount of risk around what Trump is going to do. So there was a lot of safe haven demand that started, kind of flowing towards the US dollar. Uh, Surprisingly, this is very similar to what happened to the US dollar even in Trump 1.0. So the blue line here is telling you how the US dollar index was moving between 2016 to 2019, right? Which was Trump's first, administration. And we see that even in that time, once, Trump won the elections, the initial movement of the US dollar was that there was this huge increase led by all these expectations around what he's going to do around tariffs and what that would mean for inflation and interest rates. And there was this general safe haven demand that flowed into the US dollar, right? But what's happened after January this year is that the market suddenly realized that, look, whatever Trump is coming in and announcing, that is actually not going to be good for the US economy, right? So you suddenly, within 1 month, you shifted from a narrative of US growth exceptionalism to fears around recession in the US. I mean, this change in sentiment in just a period of a month tells you how fickle and how, undirected, market is in present times, right? So you suddenly started seeing all this worry coming in, and that's when the US dollar actually started coming down, right? And since then, you've seen the depreciation in the US dollar index against both developed market currencies as well as developing currencies, right? I think these movements are very similar to what we saw, as I said in the previous episode. So a part of this, of course, is short-term, volatility or lack of clarity and reaction to all these news flows that are coming in. However, the second part, and which I'm concerned about now, is that once Trump came in and on 2nd April came in and announced the extreme tariffs across all countries, right? And this was very different from Trump 1.0, where all his tariff measures were targeted towards the US primarily. This time he came and targeted everybody. He started attacking the US central bank and said that, look, the US central bank needs to cut interest rates, or I have the power to, kind of select a new governor, right? So he started attacking US central bank independence. Then you later saw that he backtracked on some of the tariffs that he had announced. So there has been so much confusion, right, around what Trump is doing, that you ultimately are now in a situation where investors have there's some amount of damage that has already been done in terms of how markets are viewing US assets, right? And on top of this, over the last couple of weeks, you've also seen concern coming in around US bond yields. Now, this is very strange because US bond yields are the safest of the safest assets in the world, right? US treasuries are assets where everybody kind of flows towards when there is huge risk in the system. But what happened over the last couple of weeks is there's been mounting concern around US fiscal deficit, the US fiscal debt position. We did see Moody's come in and downgrade, US debt rating to AA1, which is a second notch, and they were earlier, amongst the top rated. US treasuries were, US sovereign was top rated, so there was a downgrade that happened. On top of this, Trump is talking about his tax bill, right? His fiscal bill that has already passed through the House, and it's now going to be passed, is going to be debated in the Senate. So, there is this expectation if this bill goes through, that is an additional, fiscal and debt burden that is going to be permanent in nature, right? So I think that to your question, I think that what's happened over the last couple of months has meant that there has been somewhat of a shift in how people are thinking about US assets, which goes beyond just short-term volatility, that we saw in previous years, perhaps, right? So I think that, the US dollar moderation that you have seen over the last 2 or 3 months. But in my view, I think this is here to stay. I think also we have to think about the fact that, look, Trump is talking about reducing trade deficits with the rest of the world. What that essentially means is that US exports have to rise and imports have to reduce, right? So if you want to increase exports, you will have to have a more competitive US dollar, which means that the US dollar index will actually have to come down a little bit if Trump wants to achieve this rebalancing of trade that he wants to do, right? So I think from that perspective, I think a part of the trade that we are currently seeing in the currency market is somewhat permanent in nature. That being said, I mean, I'm not arguing for the US dollar not being a reserve currency anymore. So I will not extend this argument and say that, look, over the next 2 or 3 years, perhaps US dollar is not a reserve currency, because at the end of the day, it's 60% of your trade volume is still happening in the US dollar, and you really don't have, I don't think at this stage, a viable alternative. Right. So I wouldn't extend to, yeah.
You have preempted me. That was going to be my next thing, which I was wondering and thinking about when you are explaining that situation, that Trump 1 versus Trump 2,
Yeah.
and that the similar movement and the wide fluctuations in the US dollar index, and
Right.
especially the safe haven demand. But the safe haven demand, with the situation where the fiscal deficit is widening, higher debt servicing costs for the country, and the recent credit downgrade. With all these things, as you in your graph also you mentioned that 10-year treasury is going up to 4.47, and if I'm not mistaken, probably the 30 years went very close to 5% also.
Yeah.
And when I look at the differential between India and US, I think this is one of the lowest differential we are having in the last so many years.
Right.
With some things, but US dollar still continues to be that international reserve currency, playing a dominant role in the global capital flows. I think your slide was mentioning, showing that 64% of the world debt is denominated in US dollar. 55% of the global trade transactions are in US dollars. So basically, the US dollar demand comes not necessarily from the trade countries are having with US, but also because of the overall international trade, whatever is there. Because even when I'm not dealing with the US, but I am importing oil from wherever, I need US dollars.
Yeah. Yeah.
So with that kind of situation, even despite, as you mentioned, that they are trying to reduce the trade deficit, overall trade with US may reduce, but the global trade, as long it's there, as long US dollar continues to play a dominant role in the trade transactions and the capital flows, as well as the international currencies, the demand will continue there. So
Yeah.
with that, sorry, I interrupted you over there. But what I would like specifically to have your views on How do you see the global economies are expected to adapt to these transformations? Do you anticipate, you said it very clearly, you don't see the reserve status of US dollar coming under any threat, but do you see the rise of any other alternative reserve currencies or maybe some innovative digital payment systems or evolving trade settlement mechanisms where the dependence on dollar reduces so that could redefine the future of our international finance?
Yeah. No, I absolutely agree with what you are saying that, look, yes, the US dollar might, I mean, still could continue to be, it's very likely that it continues to be a reserve currency, but that does not mean that you don't start seeing some amount of alternatives, right? Be it in terms of payment system, be it in terms of currencies, be it in terms of other assets, right? And to that, I think what is interesting is that some of this diversification away from US assets actually has already been happening over the last decade, right? So we know that central banks, of course, are very, very important buyers or consumers of, things like gold or US treasuries, etc., right? Apart from retail demand, right? And if you look at the second table here, this is showing you major central banks holding of gold in their foreign exchange reserves, right? And if you kind of look at what's been happening since 2010 to more, recent, so over the last 15 years, I think that, you see an increase and diversification, in central bank portfolios, with gold actually increasing its share, right, in terms of an asset class. And I think this accelerated more after the Ukraine Russia war, where the world realized that, look, you could be held hostage at any time because the US dollar is the most transacted and it's the reserve currency, and the US has the ability to put sanctions, etc., that can effectively, paralyze things for a country, for instance, like India, where you are such a large oil importer, right? So, or restrict your access to markets or payment systems. So I think that, countries like India, China, and some of the other, Asian countries as well, they've kind of, already started to diversify their holdings, right? And similarly, if you look at holdings of US treasuries by different countries, again, look at Japan and China. See, look, for China, we know that they were one of the largest holders of US treasuries, right? And they have consistently been reducing their treasury holdings over the last 10, 15 years. I think during Trump 1.0 and the US China trade war, that is when I think all this accelerated for China. And China realized that we have to not just, diversify our trade supply chain, but also think about diversifying our holdings and our portfolio, right? And you are seeing these show up in hard numbers, right? So this is one thing where, as we were discussing in the broader context of that, does the world, is there some change or transformation that is going to happen? To that, I would say that some transformation is already happening, and what Trump is doing currently just accelerates it, right? So I think that, for instance, central bank buying of gold is just going to get accelerated from here on, because you want to kind of safeguard yourself from any sort of major losses, right, that you might have from a very sharp increase, let's say, in US yields, right, because they can't get their fiscal situation together. So this is one thing that I think underlying change that is already happening, which will just get accelerated. In fact, the increase in gold price that we have seen, a lot of people say it's because, inflation was high, or because, there was safe haven demand, etc. A lot of the gold price increase we have seen over the last 2 years is actually being driven by central banks buying a lot more gold, right? So this is clearly, one thing that, one change or transformation that I notice. Secondly, coming back to, alternatives now, in terms of currencies, as I was just showing, this chart is just showing you, the percentage of total, you trade in different currencies, and the green, shaded area is the US dollar, right? So it is about, 60%. It's still very, very, it still continues to kind of dominate, and we think this will continue. What is the other alternative that you can really look at, right? One is the euro, the second is the CNY, right? So now, while some trade shift might happen in, euro, be it euro denominated or CNY denominated, I think inherently these currencies or countries might not be in a position to actually gain a greater share or become a reserve currency in any way. Right? For China, we know there are just too many capital controls that are in place. Their currency is not also freely floating. For Europe, I think that the fact that they still have a lot of debt problems, right? It might not be across Europe, but there are countries that continue to face a lot of debt, debt and fiscal deficit issues. And so much disparity within the Eurozone, which again and again, brings into question whether the Euro can stay together or not. I mean, these questions and ideas that are again and again brought up, I think limit the euro from becoming, a major alternative for the dollar, right? So that's where these currencies are. The other thing that you I think they mentioned, and some people, have been kind of mulling over, is that, look, so do we are digital currencies perhaps an alternative that we eventually move to, right? So is Bitcoin or some other currency, digital currency, the next thing, right, that kind of takes over? And this is not something that will happen, of course, in the near term. I mean, this is a very long-term play, but is that viable? See, at this stage, the problem with a lot of the, if you look at the digital currency markets, is that they are not stable at all, right? So from a structural or fundamental perspective, what is it that is driving these markets, right, is completely unknown. There seems to be no correlation with other asset classes. So for the US dollar, we know it's a stable asset class. US Treasury, we know relatively it's a stable asset class. There are certain fundamentals that govern these markets, right? For things like digital currency, I mean, a post on X can actually move a digital currency very, very sharp, right? So it is still very, very unstable. There are also concerns around the regulatory environment that will eventually come through, right, on the digital currency front, right? So I think there have been things that have been, Europe, for instance, or in India, we know, for instance, et cetera, et cetera. So I think this, again, to my mind, is at this stage not a viable alternative. Although, whatever I have shown you, be it Euro, CNY, a little bit currencies, gold, etc., all these could see an increase, the believe that there will be some diversification away from, US assets. Sorry, I think my connection was not stable. Am I audible?
Yes, yes, sure. Well,
Yeah.
in between there was a small break, but it's okay.
Sorry. Yeah. So yeah, that's it. So that's the, to your point, that's, kind of what I wanted to argue.
Thanks a lot. I think you have covered most of the points, and you have also given that outlook about the shift from US Treasuries. Major attraction attractive currency looks like gold as of now, as CBDCs or the Bitcoin especially doesn't look to be the next best alternate, and obviously for obvious reasons which we have explained. And India's story was quite interesting, moving from 8.4% to 11.4% the share of the gold. I'm very happy that my wife is not listening to it, because all along I have been trying to tell her that gold is a non-productive, non-remunerative asset, and she will feel really bad when she realizes that central bank is following the philosophy and the policy, and I was allowing her to do it. And before I move on to the next point, which I would like to shift the focus towards India specifically, I would like to also, for the benefit of everybody, all the participants here, mention that in case you have got any question or query, you can type it on the chat window, or maybe we can take it up towards the end. And for your information also, Sakshi, I can see some questions some of the things you have already clarified.
Okay.
Somebody is asking, will cryptocurrencies like Bitcoin and stablecoin become an alternative to gold, which you have already explained to a certain extent, giving the reasons why these things can't replace gold as that safe haven currency or maybe that reserve currency. There are a few more questions
Right.
also, which we will take it up towards the end. Now,
Sure.
continuing and putting the focus towards India in all these things, whatever the interplay of all these forces are happening, and with global increasing trade protectionism, especially when we are looking at towards achieving towards that 2 trillion international trade, and all these headwinds are not looking very positive for all that aspirations we have set for ourselves. And recently, if I look at the IMF also in its latest World Economic Outlook, they have revised the Indian economic growth projections for 25-26 downwards from 6.5 to 6.2%, though overall it still looks quite attractive. What I would like to know from you is what is your take on India amongst all these global turbulence which we are seeing, which we are facing? How are we positioned? Are we well positioned to shield ourselves from all these major disruptions? Is there a greater opportunity to leverage these shifts and capitalize on emerging prospects to accelerate our journey towards Viksit Bharat, if I may use that term, which has become very popular of late?
Yeah. Right. No, fair question. I mean, we ultimately have to think about what does this all mean for India, right? So, before we understand where we are headed, I think it's good. I just thought that to give you some context of what's been happening with India growth, right, over the last, 2.5 decades, right? So, in general, I think we've had two broad phases where average growth for India has been as high as 7.98%. So we are familiar with the first phase that happened during 2004, 2008, where there was a lot of investment growth that was happening in the country, and it was there was a lot of monetary and fiscal support, and we saw high growth. After that, you had the 2008 financial crisis, and we saw a fair bit of volatility and moderation on the growth side. Then again, I think during 2015 to 17, 18. Again, we started seeing an increase in India's GDP growth. A lot of this was led by government spending as well as some improvement in consumer demand, right? Unfortunately, after that, we saw, the pandemic and a huge dip across the globe, including in India, in domestic demand. Now, what's been happening over the last 3 years is that India actually has averaged above 8% in terms of its GDP growth, right? Even if I remove a lot of the base effects and this, the statistical nitty-gritties from this, I still think we would have grown on an average, between 7 and 8%, which is, I think a very, very strong growth number. Right. So why did this happen? I think one of the reasons was that you started seeing a lot of this pent up demand that was there in the system, and people just went out. They were sick of sitting at home, and there was so much spending that started happening within services. Right. So that was one of the reasons why you saw this growth increase. Naturally, the growth was also supported by the government, because the government had been spending, they've increased their capital expenditure spending considerably over the last 3 or 4 years, right? So you are now looking at almost 11 lakh crore of just capital expenditure spending for FY26. So that's a significant number. So that was another support that kind of came in and helped us. Um, some of these, kind of factors that, led to this increase in growth. Unfortunately, last year has been, a slow year for India. So what started happening is that a lot of that pent up demand slowed down. The rural economy was already under some pressure, right? Because we know over the last 3 or 4 years, monsoon had not been doing well. There was unseasonal rains. There was hit to balance sheets in the rural areas because of COVID related health expenses, etc. So a lot of that part of the economy had not recovered. Moreover, with a lot of the state and general elections, you also saw a slowdown in government spending. And therefore, growth in this chart, you can see, suddenly comes down. And now we are back again to this 6.5%, which to my mind is actually where your trend growth is. So if you look at the black line in my chart here over the last 2.5 decades, the average that you would get for India would be close to 6.5. So we are essentially back to that trend. Now, given the global environment, I think for the coming year, of course, we are not going to be immune. I think that with a slowdown in economies, like you mentioned, the IMF has revised down its growth forecast. So with a slowdown in, growth in major trading partners, I think there will be a problem for India's exports, both in goods and services, right? So there will be this effect that will play out. I think urban demand is just about going to flatline, right? I don't see a huge increase like we saw during the COVID era in terms of urban demand. The positive thing for us now is, the global side is from one perspective a headwind. So what is the tailwind for us, right? I think one of the tailwinds is that both the government and the central bank have become very, very supportive towards growth, right? So the RBI is reducing interest rates. I think it's going to further reduce interest rates going forward, and inflation is pretty much manageable in India, so they have the space to do that. I think on top of that, they are also giving a lot of liquidity to the banking system. And therefore, if you look at money market rates or the bond yield curve, there seems to be now this downward pressure where all rates are expected to kind of come down. And that is positive for growth again, right? So that's the domestic bit. From the external side as well, I do believe that there is a silver lining here for us, right, that can pan out, right? So I think that, unlike, over the last couple of years where there was so much talk around China plus one and that India would gain a lot of market share, etc., but that really didn't happen, right? This time around, I think that we are in a better position to capitalize from this, disruption or trade war and perhaps attract a lot of manufacturing, right, to India in at least certain segments. So I think the clear wins for us could clearly be, places like electronics, textiles, toys, pharmas, where we compete very significantly with some of the, other ASEAN players where, the US might impose higher tariffs. Or might not be as kind with them compared to India because, there's this fear that even within these, ASEAN economies, China is rerouting a lot of its supply through these countries, right? So there might be, barriers towards some of them, which might benefit India. I think what is interesting for us also is there has been, with the amount of capital expenditure that the government has done, there has actually been an improvement in the capital productivity that we now have, right? So capital productivity is essentially how many units of output are you able to produce for a single unit of capital, right? And the lower this number is in the first chart, the better your capital productivity is. And if you look at since 2005 to now, our capital productivity is actually much better than any time during the last 15 years, right? So I think this has happened because the government has spent a lot in building roads, logistics. I think there's been a focus towards, the ease of doing business, etc. You've had reforms like, GST. There's been a lot of things on the manufacturing side. For instance, the decriminalization of, certain offenses. I mean, this is a very big change, right? These seem like very minute details, but these things have led to an improvement in the ease of doing business in general in India, right? And of course, we have now all these BTAs. We just saw, India sign a BTA with the UK. And I think from what I understand, I think textiles is clearly one space, and textile players are, one section which is hoping that this BTA is going to be quite beneficial for India. So I think there is hope. right, from a fundamental perspective for us to kind of perhaps gain some market share and benefit from the kind of change in supply chain that is happening currently across the world. Of course, I don't think that we should assume that this is a done deal, right? I still believe that skilling, labor productivity, a lot more that needs to be done in terms of our regulation, etc. I mean, we'll have to kind of really accelerate on some of these fronts for this to happen. But just in terms of pure opportunity, yes, there is an opportunity for us to gain.
That's great analysis. Few things which stood out to me was one, as you mentioned, that India looks like, not your words, just my words, looks like to be in a sweet spot basically because inflation seems to be tapering off and more room for the interest rate cut. Whereas many of the developed economies, especially the US and others, they are still grappling with that. Inflation continues to be, by their standard, at elevated level, and there is a pressure. Those people, maybe the central banks are in a dilemma to choose between fight against inflation or to ensure economic growth. Whereas India, relatively, central bank looks like in a easier situation, much better situation to be. Mm, One thing more, I would like to
Right.
have your views. You talked about that bilateral trade agreements. This we are seeing a clear shift from multilateral trade agreements to bilateral trade agreements. That's what has become the thing because of the protectionism and other things. So is that is something because each one has got its own advantages, its own pluses and minuses. Seem to be moving more towards multilateral, multiple bilateral trade agreements. Is that going to change anything in the international trade? Do you see any major shift in that overall, maybe how the global trade flows and how the global trade grows, etc.? Anything on that? And along with that, there is one question also. There is a comment rather, and how much of the consumption is a result of wealth effect resulting from paper gains in the stock market? Surely that is not sustainable. This is like feel rich syndrome. When my stocks are doing very well, I start feeling richer and I tend to become little more lenient in spending, little more easy spending rather than less focus on the saving. Do you think we are in that stage in India as of now?
Uh, right. Question, right?
I think your voice is breaking.
Humor has happened.
I think actually they're having
Uh,
some disruption in the voice. We are not able to get clearly. I don't know, is it at your end or yes, please, you may go ahead.
Hello.
Yes,
Yeah, I'm sorry. I think there was a network issue at my end. I think I got dropped off. I'm very sorry. Yeah.
no problem.
So we were
Please,
discussing
you're talking about,
the
yeah,
Indian.
the field rate system, yeah,
Right.
and
Right.
multilateral
Right.
bilateral.
So, this has been a problem, right? I mean, if you look at from the bank's perspective, if you look at the savings that are happening in conventional, saving instruments like FDs, etc., right, that has, been going down quite a bit, right? There is this strong preference, especially within a certain demographics, to move towards either physical assets or to move towards mutual funds, equity, such products. Now, what this does is, while this is a natural phase for any economy, as your per capita incomes increase and there is more financialization that happens and there's more awareness, you do start seeing, more sophisticated, financial saving instrument landscape, right? And greater participation, even from retail investors into the equity market and other instruments. The only issue here is that, very uh, sharp drops in the equity market then make you very vulnerable, right, in terms of household wealth, right, and therefore their spending power in the future, etc. So that also tends to have an impact, and that's something that, to my mind, for this year was clearly one of the, from a domestic perspective, one of the risks on the consumption growth story that we are looking at. Right. So I think from that perspective, yes, that's a problem. But I think it is in general, that's a short-term effect. But I think in general, the move towards different financial saving instruments is a positive sign from the perspective of, and this is a very natural progression for any economy, right, where you would diversify your saving sources.
Okay. Thanks a lot. Coming to the foreign exchange market specifically, as we have all witnessed, you also covered in your earlier slide, the market volatility has intensified in the recent weeks and months, and especially USD INR also has been exhibiting a well-balanced two-way movement. The
Right.
conventional notion, which we all use to say that rupee depreciates like going down an elevator and appreciates as if you are walking up stairs, that is
Yeah.
now being challenged in the recent market behavior.
Yeah.
How do you assess the market dynamics, the medium and long-term outlook for the INR exchange rate, the client
Right.
hedging strategy, since you covered the countries also,
Right.
and also the Reserve Bank intervention policy? All along, I know the Reserve Bank has been saying that they never have any specific target in mind. They
Yeah.
only try to curtail the excessive volatility. Now, excessive may
Yeah.
keep changing, the
Right.
rules may keep
Right.
changing. How do you see the things evolving in the future?
Right. So, yes, it's very, I think, a lot of people have been taken aback by how the rupee has performed and moved over the last couple of months, because we are used to, risk episode being associated with a lot of depreciation in the rupee. Right. Now, what is different this time and what explains this gains or appreciation in the rupee? One of the things is that the US dollar in itself, as I showed earlier, right, has been coming down, right? So it has maybe nothing to do with us and the rupee or India, but this is a general broad play where all currencies seem to be gaining vis-a-vis the dollar. So just look at the euro, for instance, right? I think people have been so bearish on the euro for so long, but this year the euro has broken out and beaten all forecasts, right? So this uh, loss in confidence, or this broader sell everything that is mega trade, right, has meant that you have consequently seen other currencies appreciate. So that's one factor. I think there are, for India's case, there are specific factors to us that have further driven these appreciation gains in the rupee. One is that, look, for us, commodity prices are very, very important and highly correlated with how the rupee moves, right? So the last time you had a very sharp depreciation episode was the time when oil had crossed 100 during the Ukraine-Russia war, right? So we went all the way from 74, 75 and we crossed 80, right? So this time around, because there is this slowdown in global growth and a lot of oversupply of commodity, I think oil prices and generally all other commodity prices seem to be trending lower, right? So that bodes well for our current account. I believe that if India is able to get a favorable trade deal with the US, right, and in the coming months, our domestic growth due to domestic factors kind of holds up and is relatively better than a lot of our peers, I think that would be enough to attract further capital flows into the country, both from a debt and equity perspective, right? So I think that, to my mind, therefore, for this year, there seems to be a more likelihood of an appreciation in the rupee, than a depreciation. Of course, there is too much volatility at this stage. Like we saw in May, there can be geopolitical tensions that can happen. Trump can come in and announce something completely different. Or, for instance, today morning, we have the news of the US court, making all tariff announcements illegal, right, by the Trump administration. So there are all these things that can happen. So I think from a hedging perspective, I think in such scenarios, one should keep hedging at whatever levels, that seem attractive to you, and not think that any move that you are seeing currently is part of a longer term trend, because things can change very, very quickly, right? Both on the appreciation and depreciation side. But my broader view on the rupee over the medium term would be that, look, now we need to start thinking differently about the rupee. Okay. And there are 2 or 3 reasons for this. One, we do not have a current account deficit that is closer to 3.5-4% anymore, right? Our services trade is increasing at such a rapid pace that it is now almost outweighing our merchandise trade deficit, right? So I think that there is this huge increase on the services side that is happening, and that is a big cushion for us. Remittances is another piece that has been very, very, that has seen, phenomenal growth in terms of flows over the past couple of years. So the first point is that our current account deficit is now 1% or below 1%, right? So therefore, the depreciation in the rupee every year that I would assume cannot be 3.5-4% on average every year, right? So we are in a different environment now compared to previous. Lastly, I think very quickly, since I think I want to also leave time for questions, on the RBI strategy, because I think that is very important. Last 1.5-2 years, the rupee was so tightly managed, right? And then we saw this complete change and U-turn in how, the rupee was moving over the last couple of months. My sense is that, yes, I would look at the RBI strategy a little differently. I would look at the RBI strategy in terms of rupee competitiveness, right? So till the time the rupee is appreciating, but all our peers are appreciating, and that doesn't hit competitiveness, I don't really see a need for excessive intervention apart from just curtailing volatility. So there is nothing, inherently bad about that appreciation if we are still competitive. Similarly, I think if the currency is depreciating, right, there again, I don't think that apart from, the RBI coming in and saying that, look, we can't let the rupee move from 87 to 88 in a single day. But if it is gradually moving towards that target, it is all right. I mean, that is where the RBI is currently, I think, very visible from its action and intervention strategy, right? So I think this relative openness from the RBI is both on the depreciation and appreciation side, to my mind.
I tend to agree with what you are saying, that it's not the absolute level, but the pace at which it goes, because there have been enough debates about that. Can exchange rate help in your export sustainability, your export growth or not, or the role the exchange rates play is always very minimal in the overall export strategy. It has got some influence, but not the big influence, the determining factor. One thing I must acknowledge and appreciate, that we always keep saying that I'm looking for the one-handed economist. Otherwise, most of the time people say on one hand it's likely to be, but on the other hand. But here, happy to see you that you are giving a very clear view that yes, rupee is more likely to depreciate in the coming year and going forward, because of quite also supporting by that argument.
Yeah, I might end up being completely wrong on this, but that's my assessment of, and that kind of ties in with the view that I have on the macro RBI policy and global, right? So that's where I would be kind of, tilting towards.
It's well supported by the rational arguments and the statistical data as well. So finally, the last thing which I would like to have your views on is that we all along have been talking about internationalization of rupee. As we said, that's trying to de-dollarize, but we don't use that word. We're saying we are only trying to internationalize rupee. How, in your view, the recent policy changes by RBI allowing non-residents to open INR accounts in the overseas branches, Indian exporters to open and maintain foreign currency accounts overseas, encouraging third country trade settlement in INR. What many things have happened in the recent past. RBI is looking more open, more receptive to the new things, new ideas. You also covered RBI as well as government. Both are very much keen, inclined to provide the necessary infrastructure and the support system. And in this situation, how do you see that basically are we in the right direction to improve familiarization and acceptance of rupee as a currency for invoicing and settlement of international trade, at least within our own block of countries with which we are trading? Obviously, we are nowhere comparing ourselves with China or Euro or other currencies which you covered in your graph earlier. Maybe within our own block of trading partners, do we see any progress or we have any chance of that?
Yeah, I mean, look, the short answer to that is that yes, I think this is something that clearly there's a lot of policy intent, both from the government and the central bank to push the internationalization of the rupee. And there's, been a lot that has been done on this front. Um, with this kind of push, yes, I mean, with certain countries, I mean, we know the examples where some of this is perhaps already kind of happening. We have trade settlements and opening of special rupee vostro accounts, etc., that has been put into place. India is trying to use UPI interface with some of our neighboring countries, etc. So I mean, yes, all this is fine, and I think if we continue doing this, then perhaps there is some traction that happens on this front. But I'm still unsure of a path where this could gain a lot of critical mass, right? Because uh, you you need conventionally you perhaps need to have a current account surplus, and this is, I'm just saying as an economist, right, from the macro perspective, right, for this to eventually start working in a particular way. I mean, the US is different, and even with the current account deficit, they are able to achieve this, right? But I think that for internationalization of the rupee, we also have to not just facilitate the trade, etc., and make that part easier, but then we have to also move towards making Indian assets more attractive in some way, right? Because I think we have to work on the regulation on that front as well, because ultimately what is the importer or the person who has those rupees, what is he ultimately going to do, use those rupees in? So right, all that money should eventually come back to India and be invested somewhere. So I think that's one bit that we still have to figure out. um, um, yeah, so I mean that's my broad take on this issue.
I think the point you made is very valid that first need to be current account surplus. That can be two factors, increase in our exports, so making our assets much more attractive and open that. Basically, otherwise, as you said, it's right. And we are already facing that problem in the banking system. People accumulate the rupees, but what do you do with that?
Yeah.
I'm not buying anything from you, or I'm not investing, not finding attractive enough invest. So that probably is something which need to be worked upon.
Right.
So before I open up for the questions for people, there's something more on the chat window. Somebody has typed. I'll just read it out. Has the word global economic order changed already, structurally, fundamentally, systemically, and more significantly, a change irrevocable? Is the Indian economy, all stakeholders, government, industry, agriculture,
Sorry, I
consumer,
think
are
you're
they all flexible?
sorry, can you please repeat? Actually, I'm not able to hear you properly. There's some network.
You can just open the chat window. Open the chat window. It's a question over
Yeah.
there. The
So
last question.
the last question, has the world global economic order not changed? You're referring to that.
Yes, that's right.
Okay.
Yes, that's right.
No. So the point that you are making, that has the global economic order not changed? Of course, I think in my, discussion today, I did highlight the fact that there are changes that are already happening. So, for instance, one very, very big change that is not recent, but has been happening for some years now, is the fact that the whole world economy is moving away from globalization, right? Everybody is moving towards trade protectionism. Everybody is looking inwards. And all these changes have been happening. And I kind of agree that all this means that, with Trump coming in and whatever he's announced over the last couple of, months, means that all these changes get accelerated, right? So, I completely agree that there is this change, underlying change that is happening. To that extent, whenever there is a change that happens, there will be some positive, some negative for us. So yeah, I don't think that we are completely flexible or will be able to cope and adapt to this completely at, day zero. But I think that there will be certain sectors or certain sections of the population or certain sector of the industry that could end up gaining from how some of these things are changing. But as I also highlighted earlier, that look, we are not immune to a global growth slowdown. So if there is a slowdown that is coming our way in the global economy, we are also going to see an impact of that in India, right? So
Thanks a lot, Sakshi. Thanks for your time. Very illuminating and very well explained all these critical points, which most of the time we get stuck somewhere or get confused with the mimicry of very numbers of people say that statistics, you can go on squeezing till you find the right answer.
yeah.
But there you are given it the right twist and the right way, the way I explained everything in a very simplistic term.
Thank
It was
you.
quite helpful. Thanks a lot. And I must tell you that today, after a long time, we crossed the participants to 3 digits.
Oh
That
wow.
shows that relevance of the topic and how much people were keen to look at it. So
Oh,
thank
thank
you
you.
very much for your time. I know despite being little under weather, under water, and you still could spare some time and join us today.
Thank
Thanks a
you.
lot. Thank you. I
Thank you so
appreciate that.
much for your time. Okay. Thanks everyone. Thank you. Bye bye.
Bye.